What's up, guys? William Ryan here, back with another video. I know it's been quite a long time, but today we're going to be jumping right into a trading plan that I've created for you guys. I know a lot of you guys get kind of chopped up or confused with certain William divergences, and you end up being on the wrong side, and you ask yourself why. Why did the William not work? What happened? And today I'm going to try and give you guys some insight on why this is occurring. And it's because we're not paying close enough attention to the things that are happening before our optimal advance setup. So in this trading plan is fractal in nature and can be applied to every type of trader, regardless of time frame or market. So whether you're a swing trader, day trader, scalper, okay, this can work and be applied to you and help you out in your trading. And so the order of events that we want to see before optimal advance, we're going to be going over those things today. So the first thing that we must see, okay, is the SMT on significant highs or lows, right? So here on Ethereum, we're looking at Ethereum and Bitcoin on the 1 hour chart. Here we can clearly see that we have SMT divergence on this respective high. Ethereum is taking out the high, while Bitcoin is failing to take out the respective high. What does this indicate to us? It indicates a potential change in state of delivery and that lower prices are likely to unfold. So that's the first thing. And what I do want to go over here is the power of three. So there's a couple ways that the power of three will form visually in a chart. And so this is the external range power of three setup. So we have consolidation, expansion, reversal, right? So there's external range power of three and internal range power of three. This is the external range power of three that we like to see caused by the SMT, right? And typically this is the first leg of that market maker model. The internal range power of three, which we're going to get into, is the second leg in the market maker model. So the SMT here is confirming lower prices. Okay, we get the distribution lower. That leads us into the second thing here that we would like to see before we want to see optimal advance. And that is the market structure shift. So two things must happen to confirm that we are in a sell model and that the first leg of distribution is about to end. Okay, that's the market structure shift. We want to see lows, old highs or lows, get taken out after the SMT here. Okay, that's the first thing. It gives us good confirmation, right? It's great, but the second thing is the most important thing. So you can see here, market structure shift B. We want to see an old fair value gap get traded through, forming a balanced price range. We don't want to forget about the buy side of the curve. In most instances, okay, on the sell side of the curve, like we're looking at here, okay, the highs and lows are going to be forming at balanced price ranges formed on the buy side of the curve, like we can see here. Right? So this is very, very important. We do not have a market structure shift until lows are broken and a clear balanced price range has been formed like we have here. So this fair value gap, we extend it out in time, right? We want to be very, very aware of this level in here. This PD array is so important, guys. I cannot stress to you guys enough. This is going to help your win rate and your profitability overall. You must take into account the fair value gaps that get turned into balanced price ranges on the opposing side of the curve. Once this market structure shift is confirmed, the low here that gets formed, this is typically the end of the first price leg in the market maker sell model. Okay, typically on a good market maker sell model, low resistance, we want to have two legs of distribution, not three, not one. I like to see two. Okay, so now that the first leg of distribution is accomplished, we want to be looking for the internal range power of 3 start to occur and ultimately lead us to our optimal advanced setup, right? So we create the low. Okay, we have a small consolidation in here. See this contraction? This is what I like to call contraction, okay, aka consolidation, right? So we trade back up into a fair value gap that got left, okay? Order block, we have this wick here and this balanced price range. So these are 3 PD arrays that I like to typically see in my optimal advanced setup. The order block right here, these 2 up close candles, balanced price range on the buy side of the curve, and the fair value gap that gets left here. So I have all my PD arrays present. No, it doesn't have to trade up into the order block here. It's actually better if it doesn't, because that aids in us expecting the suggested form of price delivery, which is expansion, right? So we have all the PD arrays present that I like to see. And now we want to look for that Williams percent R divergence. Okay, this really gives us confirmation that we are going to see a change in state of delivery, that we are going to see the internal range power of 3 unfold, right? So price trades up into our PD arrays into a premium market, and then we sell off, okay? But the most important thing here is the Williams percent R divergence. We have this respective high here, okay? In the Williams percent R, we are taking out that respective high, but in the price chart, we are failing to take out this respective high, coming into a premium, coming into optimal advance, the 3 PD arrays that I mentioned. This is a great trading opportunity, okay? Beautiful delivery, low resistance liquidity run type delivery, filling in this void completely and stopping right at the order block here, right? Beautiful low resistance liquidity run. Beautiful, beautiful setup here. And yeah, that's pretty much it, guys. Like, what we really have to look for, and you guys should be studying if we want to have success with this type of model, is you really want to see that external range power of 3 happen before. Okay, the internal range power of 3. This is going to confirm to you guys that we need to be looking for optimal advance immediately after these things happen, right? So going back to month 1, episode 1, I remember ICT when he made that video, I believe he mentioned, he's like, you guys are going to come back to this video, and this video here will be the most important video that you ever watch from me. And for me, it absolutely has been, right? So consolidation, expansion, reversal, first leg of the market maker model. The second leg of the market maker model, consolidation, retracement, expansion. Market maker model done, right? So I hope you guys found this video insightful. It's a short one. It's a quick one. But if you're new to the channel, I would highly recommend you go back and look at the other videos that I posted, and it'll make a lot more sense if you're new. And again, if you've been struggling with trade selection and you're using the Williams percent R to confirm your trades and you're getting stopped out and you're offside, this is going to be very, very important. This is going to help your hit rate. It's going to help your profitability, right? These 2 forms of power of 3, we need to see the external range power of 3, right, before the internal range power of 3, okay? So we're not just looking for the internal range power of 3. We need to see the external range power of 3 before the internal range power of 3. Okay, so if you guys get really good at this and noticing the SMT and the market structure shift with the balanced price range, OA typically should come right after, right, if we are in a low resistance market maker model. All right, guys, so I know this is a quick video. I'm kind of pressed for time today, but I really wanted to put out a video today. And if you guys, as always, if you have any questions at all, please put them in the comments and I will try to get back to you guys as soon as you can, or as soon as I can. And until next time, guys, I hope you guys have a great weekend and we'll talk to you soon.